trying to hold 2690. Let's get to Bob Pisani this morning. Hey, Bob.
Well, it's a good start, but remember something. It was a very good start yesterday. This is another gap up that we've seen here. 3 days in a row, we've gapped up rather nicely. But again, good start yesterday. And actually, the same leadership group today started out as the leadership group yesterday. And those are the sectors that are most beaten up. So we see energy up, banks up, retail. This look familiar? Interestingly, REITs are lagging a little bit. Consumer staples also were lagging yesterday. So this has a very, very similar pattern. We'll see if this plays out. Remember, we had a 90-point gain in the S&P 500 that essentially evaporated. And I think the question everybody's trying to figure out is, where are we? Are we in a bull market or are we in a bear market? What is it? I'm calling it the markets in the middle because, frankly, you can argue both ways here. And I think it's very simple here. The people who are screaming the market was the buy of a lifetime 2 weeks ago, well, they don't have as much of an argument now with the markets. Look, 22% off of the bottom that we've seen in the last week or so. And we are, by the way, 21% off the 52-week highs, the historic highs on February 19th. At the lows, we were 35% off. So is this a bull market or a bear market? You tell me. I just say markets in the middle. What it means, folks, is we've essentially regained 45% of our losses, maybe, that we've had. That's a significant rally. So everybody who says, oh, it's the buy of a lifetime. Well, maybe, but, you know, rhetorically, it's a little harder to argue now, considering what a long slog we have. The risk-reward ratio has changed dramatically because of the size of the moves. And if you look at some of the names that are out there in the Dow stock, I'm just picking some Dow stocks right now, since the February 21 close. Remember February 21, that weekend when things started to really fall apart, the coronavirus headlines started getting really serious? Well, Walmart's actually up since then. Verizon's only down 2%, Merck's only down 5%, 3M's down 8%, Microsoft is down 9%. These are not trivial declines, but compared to where we were a couple of weeks ago, this is well off of the lows for a lot of the big names here. So the good news, I think, is that the strategists, the top-down guys, they're starting to coalesce on their opinions on 2020 earnings. They're still clueless, but they've gone from utterly clueless, at least to figuring out where some numbers might be. And if you look at some of these estimates, it's coalescing around 20 to 30% decline for 2020. Now, obviously, this can change, but I'm heartened by even just a 10-point swing here. RBC is the more optimistic. Goldman's a little more pessimistic. But let's use down 20%. Even assuming a 20% decline in earnings, the market's still pretty expensive right now. That would be 20-time forward earnings right now. So it's tough. And remember, we've got a very long slog. Every day, the thing I look at, withdrawn guidance and furloughs, because it's a very good reminder of what's going on here. And today we had several again. So McDonald's, for example, came out. They withdrew their guidance. Pinterest came out. They withdrew their guidance. Levi's last night, they came out. They withdrew their guidance. Tesla is furloughing people left and right. Dick's Sporting Goods. You can see the wide array of people. This is a refreshing way to get up every morning and remind yourself, okay, look, the Fed may have the ultimate bazooka, as Larry Kudlow said yesterday. That was widely passed around, and maybe Mr. Kudlow's right. Don't fight the Fed is right. But it's a long slog, and looking at the withdrawn guidance and the furloughing every day, in my opinion, guys, is a very refreshing way to remind yourself that this is still a very, very long slog. And maybe that's why we get those failed rallies late in the day like the ones we had yesterday.